Good morning, everybody. I'm Rich Kendrick, Senior Managing Director for Equities at KBW and Stifel Nicholas. With me, I have Barry Sloane, Chairman and CEO of Newtek, ticker NEWT, and Eileen Palmer, who is Head of Strategies at PennantPark. They have two public BDCs, PNNT, which is more of a fixed rate, and then they have PFLT, which is a short-term, floating rate BDC, one of the 3 or 4 that are out there. I thought for everybody's sake, because probably most of you were here last year, we would just run through a very brief, sort of where the market has come in the last year. Last year, the NAVs were trading, most of the indexes, or if you look at the 2044 public REITs, public BDCs, they're trading at 90% of NAV. Now they're at 92.2% of NAV. Average has been about 90.7. Short interest has gone up from 1.3 to 1.6 in here. Everybody needs to realize that with these dividends, these stocks are very hard to short because you're having to pay a lot for them, and sometimes they're very hard to borrow. What's interesting is the market has totally recovered back to last year's levels. During the December debt tantrum, the S&P probably sold off 9%. BDCs probably were just a little worse than that. If you look at it year to date, the BDC markets are up 12% versus 9%. And yields are down currently a little bit from 9.1 versus 9.6 last year. No matter which sector you look at, we look at it in 500 million and above, 250 to 500, and then under 200. All are trading right around a 90 mean and a 90 median average NAV. These 3 BDCs are all in the just barely under 500. We would expect with some recovery and some additional issuance, to see them move into that upper bracket. As a way of sort of looking at this, in 2012, there were 23 deals done in the BDC market. 11 of those were baby bonds. We'll come back to that. Last year, there were 44 deals done by BDCs. 16 were baby bonds, and this year there have been 11 deals. Three baby bonds have been done. We expect there to be 2 or 3 BDC IPOs this year, and we expect there to be continued M&A activity as some of the smaller BDCs without big parents just can't they can't really grow, and so they've turned themselves into sort of dead money. With that, I'm going to ask Barry to sort of briefly go over Newtek, and then ask Eileen to get 30,000 feet on the Pennant entities.
Thanks,
Barry.
Rich. Good afternoon. Newtek Business Services Corp, internally managed BDC, stock symbol NEWT. Our website is newtek1.com, NEWTEKONE. We've been a BDC for approximately 4.5 years. We've been a publicly traded company since September of 2000. We're very much of a unique BDC in that we actually have operating businesses sitting underneath the BDC umbrella. The 5 primary business lines: we are a small to middle market business lender. We are also a payment processor. Our payment processing business is significant that we do have to disclose because it's a material portfolio company in our overall portfolio. We're also a tech solutions company, insurance agency, payroll, health, and benefits. Companies had a very strong track record over the last 5 years in excess of a 20% total return per year. Last year we beat the major market indices by 5 to 10%, and this year we're up to date we're running about 29% up year to date, including the dividends. So we're pleased with how we're performing, but we're very different and very unique than most of the BDCs.
I'm Eileen Patrick. I'm head strategy at PennantPark. PennantPark has actually been around since before the global financial crisis. The BDC PNNT ticker, is PNNT. PennantPark was founded back in 2007. I think Rich touched on it has more of a what we call across the capital structure. So you will see, in addition to first lien, you'll see some unitranche loans, you'll see some second lien. So we're able to solve problems for companies and financial sponsors that could be both second lien, some junior capital, as well as some senior capital. In 2011, we founded PFLT, which is the other publicly traded BDC, PennantPark Floating Rate Capital, that has a predominantly senior focus, like 90%, 99% is actually first lien in that portfolio, 100% is floating rate, and that's what we sort of joke that, PNNT is safe enough for your mother, PFLT is safe enough for your grandmother, because if you look at the risk profile and the return profile, those are a little bit different risk reward, but we like both of them very much, and we tend to focus on financial sponsors as the source of our underlying loans, which tend to be cash flow loans. And so that's been both of them have grown nicely, and we've been able to do a lot of things. We've grown very nicely and have been very proud of the track record that we've had since before the credit crisis. I think our older fund, PNNT, I think has 30 basis points of cumulative losses in the 12 years that it's been in inception.
That's great. I think one thing that we have not really talked about so much in the past is everybody wants to talk about their portfolio, but I think it's important to realize that in the last couple of years, additional sources of financing have become available to BDCs in institutional bond deals, what we call baby bonds, which tend to be senior unsecured, 5-year non-call 2, 7-year non-call 3, 10-year non-call 5. They're all listed on the New York or the NASDAQ. We're continuing to see JVs for financing. We're continuing to see senior loan funds that are sidecarred onto these things. And so we think that the BD universe, by and large, has tried to move off 100% bank lines. If you think back a couple of years ago, when the credit crisis hit, the banks tried to pull or shorten their bank lines to the BDCs. Some of them couldn't get bank loans, or the bank loans were at such exorbitant rates. That is no longer the case, but I think we're going to ask both of these guys how they sort of look at how we were funded versus just sitting on a handful of banks' bank lines.
Well, from an issuer's perspective, I think we've done 3 separate raises on baby bonds. From the standpoint of ease, came right off of the shelf. Frankly, they were very easy to do, didn't require a roadshow. I think with respect to investors in baby bonds, I'll be Captain Obvious for the moment. It's really important to look through to the underlying assets. Is this BDC loaded with sub-debt, mezzanine equity, or is it senior secured? What's the real leverage ratio? Is there SBIC debt in there? Is there not SBIC debt? How levered are the underlying assets? So in our case, we've always been a very under-levered company. We've been around for 19 years, so we survived 08, 09 without a government bailout and have always been able to manage a risk. I think that's rewarded us with good, effective pricing in the baby bond market.
And from time to time, we have had baby bonds outstanding. We've had publicly traded high-grade debt outstanding. In both our funds, I think the thing that we certainly focus on is having, I would say, a variety of diversity in financing. So we do have the classic bank lines, but we also augment that with unsecured debt in varying forms. Some, come in the form of like SPV ring fence financing for some first lien assets. Again, all the debt consolidates, but we just try to finance, I would say, with sort of long duration so that you don't have any maturities coming up on you. But you also have, I would say, a variety of tools in the toolbox in terms of unsecured debt, secured debt, and a variety of counterparties. And I think I was looking at a sheet the other day where we probably have north of 20 different banking relationships, and that doesn't include the SBIC debt, doesn't include like high-grade debt that we have outstanding, but like you have 20 different banking relationships, and the tenor's long, and I think we probably manage over $2.5 billion of debt in our variety of funds.
Thank you, guys. We believe that both the size, where you don't have to go out like in Aries and need to raise $300 to $500 million at a clip, that these smaller guys have the ability to go out and do $50, $75, $100 million with pretty decent, with very good execution. Most of them are now carrying Egan-Jones rating, as everybody here is aware. This year, under the Small Business Jobs Act, they let the leverage go from 1-to-1 to 2-to-1. I think if you really look at it, nobody really ran at 1-to-1. They ran at 0.8, 0.9. Now they're running at 1.2. Standard & Poor's didn't like that, knocked a lot of the triple Bs down to double B plus. Most issuers dropped Standard & Poor's, and we have seen Kroll and Egan-Jones step in. The reason this is important for you all is the baby bond market is not purely a retail business. About 30% of this stuff, because of the NAIC rating you get with a triple B rating, are going to small insurance companies that buy $1 million to $2 million. There's also been a developed funds that just buy baby bonds. I think another thing that I think very much differentiates BDCs from closed-end funds is the kind of research that everybody in the space has. If you think about most closed-end fund research, it's based on, are you above or below NAV? Very little of it has to do with what strategy, how the assets are going to line up, how the debt is going to line up. Where in the BDC space, these, while they are 40 Act companies and theoretically closed-end funds, the industry provides company by company research. They talk about strategy. They talk about every asset in their portfolio. How are they funded? And so I'd be interested to hear from you guys what you think of the importance of the ratings and the conferences and all of that means to you guys.
Well, I think that, as Rich pointed out, from a rating agency perspective, Standard & Poor's, who probably was the leader in the business, but they were the leader based upon 1-to-1. And after that, in my opinion, there was not much to the rating. The other rating agencies are doing a deeper dive looking into what we're doing. But you need to really be transparent and look through the assets. Yeah. In our portfolio, one of our biggest portions of the portfolio is our SBA 7A business, where we make a loan, we sell a government guaranteed piece off, and we're left with an uninsured but non-subordinated class. The average loan size is $180,000. It adjusts over prime. We've been in that business 17 years. We've done 9 securitizations off of that collateral. They're all in Intex. So it's very easy for investors to actually follow the creditworthiness of the loans that Newtek has done over the course of 16 and 17 years with respect to default frequency, severity, and diversification. I think it's certainly advantageous for investors to be able to invest in debt of these companies if they can actually look through and see what they're investing in. So if you look at our Ks and Qs, every single loan which is marked to the market every quarter is in there, whether it's a $5,000 loan or a $50,000 loan or a $500,000 loan. It's in the Ks and Qs, and it goes through a rigorous process every single quarter.
No, I think you touched well on fundamentally what we think some of the transparent advantages are for BDCs. And when we tend to think about leverage, it's to the point you were making. So we have the one fund that has some junior debt and some senior debt, and it has probably more senior debt today because of where we think we are in the credit cycle. But when you think about leverage, you think about that in the context of the kinds of assets that you have in the portfolio. So for PFLT, which is our more senior focused fund, that is, we've given guidance in terms of, how do you think about leverage there? And that's probably comfortable, 1.4 to 1.7 times. And our fund that PNNT that's across the capital structure and has some junior debt, I think it's like 45% sort of second lien and, some equity. And, that's probably 1.1 to 1.5 times in terms of a target ratio. Today, we're well inside of, these ratios for our funds. But, again, to the point of being able to look at, what are the underlying assets? We have the same process in terms of each and every quarter. Every loan that we have goes to a third-party valuation firm. They independently come back with an actual value. So, we're not in the valuation business, but that at least you can look at each and every loan that we have made, and it's entirely transparent. One of the things that, when people think about financial services generally, it's harder to have, I'd say, such a transparent view with, a bank or an insurance company because you get, just sort of big asset classes. And, here you have perfect transparency to every name. And I think, as Rich was saying, the notion of research and why is that important, I do think in the BDC space, analysts have gotten better and better over time to be able to talk about, what is the strategy, what are the assets, and, that gets, I think people to better understand the business.
Coming back to your question, Rich, I wanted to add one other thing. I remember before they changed the leverage ratio, being on an earnings call, and I think we were like 0.83 or 0.84 in the leverage ratio. One of the analysts said, "Oh my God, isn't that really high?" I said, "No." And they said, well, what do you mean? I said, well, frankly, we were a non-bank lender before we converted into a BDC 4.5 years ago. We were leveraged 4 to 1, and we survived 08, 09. So if you're a baby bond investor and your sole investment is predicated on like 1.3 to 1.7, I think you're missing the boat. And I think even at 2 to 1, these are very modest leverage ratios, but it's real important to look through the company, see what they're investing in, see how long their track record is, and you can get a pretty good feel for how much risk you're really taking on, as well as whether you're in senior secured or mezz and SBIC debt. You really need to do a full evaluation. And but I definitely recall that conversation. And it's like, so I went back to the analyst recently. I said, "Do you remember that conversation?" He said, "Yeah." I said, "Well, what do you think now? It's 2 to 1." I mean, and it's the same analyst that's actually upgraded us from a stock perspective, because we don't believe at these leverage ratios we're taking on significant risk. There's plenty of equity underneath the inherent debt for investors to be comfortable with.
Another couple things. I think when you look at BDC debt, if there was a deterioration in asset quality, unlike a closed-end fund, the BDCs just can't issue more debt, but they have time to be able to rebalance their balance sheets. A closed-end fund, and some of the sectors have been particularly hard hit since the meltdown. You have to cure. So in other words, you have to go out and liquidate securities, and when you're doing that, you're probably doing it at very close to the bottom of the range. So it can really leave some pretty big damage to NAV. I think if you look at these guys and the way they use these BDCs, they all have a call feature. So as interest rates have come down, BDC baby bonds have tightened probably from 600 off to 350 to 400, maybe even into the low 300s off. You're still talking about single B type levels on what we believe to be sort of a triple B type of credit. I don't think anybody has lost money. I'm not saying they haven't lost money if they sold it, but there have been no defaults where anybody has been hurt in the BDC market. I'm not saying that couldn't happen in a major meltdown, but I think those things are pretty interesting. The other thing is if people start to look at this space, you need to watch the yield to the calls. These deals all have short calls, and so they may be just trading at 25.5, but if they're callable tomorrow, you're going to have a negative yield to the call. And the market is robust enough that as you run in the yield curve, you get closer and closer, it all of a sudden makes sense to finance these things, move them back out so that they have a little longer duration. So that is one thing that I think people forget about when you just look at a ticker and it's like, wow, these sevens are trading at 25 and a half. Those sevens are going to be refinanced out in the next couple of weeks. So that's just sort of something to think about. How are you all seeing, are you guys seeing spread compression, which affects everybody, closed-end funds because of the high yield market, BDCs because of what they do? Are you seeing yield compression sort of in the middle market? If some people, we've seen some dividend cuts in here.
Because of the way our business model works, which basically is direct to the business owner, and there's no intermediary, a business development officer, a loan rep, a broker in the middle, we fortunately haven't seen spread compression. In the SBA business, we've been prime plus 2 3/4 max for 9 years running, don't have to cut the rate. We structure loans for borrowers. We don't position ourselves as an SBA lender because we do other things than make government loans. We now have a program with BlackRock TPC to do non-conforming loans. I think we're somewhat unique. We're direct to the borrower. There's nobody coaching in the middle, and therefore we're not typically in a competitive state. Where we are competing is if the borrower can put down 30% equity and basically get a bank line, they're going to wind up getting cheaper financing than us. We're basically in a non-bankable area because we're 10 to 25-year amortization, because we are no covenants in the loan, and a single-digit interest rate. So we give borrowers favorable terms that don't work for banks, and we're able to get a rate. Everything's personally guaranteed, so we think that the credits are good and strong. I should also note that all of our securitizations, which were S&P rated, have held their rating or been upgraded over the course of 9 years.
And on our end, we focus on, middle market loans. So average EBITDA of an underlying company, maybe 15 to, 35 million. So when you think about where most spread compression comes from, it comes from a more broadly syndicated market, right? So we are middle market, and we still tend to get, we get covenants on our deals. We, definitely focus on, call protection on our deals, but we focus on companies that we think have, strong recurring free cash flow. We tend to cover middle market financial sponsors. That's where we get, probably 90+% of the deals that we are seeing. Sometimes we occasionally do a direct loan to a company that we may have known for a long time or have known the management team or something to that effect where you have an edge. In today's environment, we've certainly been moving up capital structure. So even in PNNT, I think 55% of the portfolio today is first lien. So one could look at, if you looked at us probably 2 years ago, the average yield on a yield basis was maybe 12% of the portfolio. Today, it's like 10 and a half, 10 and 3/4, something to that. But that's been a function of moving up the capital stack. Is it a competitive market? Yes, there are times it can be a competitive market. We tend to, because we've had long-standing relationships with sponsors, where something is about like the last basis point on a loan, those aren't, those don't tend to be the loans we make. We want to be able to be constructive on a situation. We have to like the risk reward. But if something is going to be sort of priced to perfection where, other people will probably be far more aggressive than we would be. So I think long-windedly to answer your question, yes, the market's gotten a little more competitive, and, but I think we've also taken the view that we would much prefer trading off a little bit of rate if we had to, relative to, because covenants to us are, important. So being able to have maintenance covenants and, having, a lot of sort of sponsor equity and keeping leverage relatively low in the underlying companies, that's far more important to us.
That brings up an interesting point, and I think, Barry, this one the way you operate, this one may not be so relevant to you. There is a concept that there could be less defaults because everybody's moved to covenant light, or so many of these big deals are covenant light. So it's hard to get them to go bankrupt initially, but if they do, the severity is much, much higher. And I was wondering if either of you guys had sort of a view on that, because you both, especially you, Eileen, because you moved up the capital structure and you do get covenants.
I think, inevitably in a credit business, you will have some bumps in the road with the company. No one's going to have 100% perfect track record. You touched on, being able to have the runway to figure out, what do you do if you have a bump in the road? So, we do have restructuring expertise. We are able to, there have been times we've actually taken over the company, changed out management teams to be able to, basically, if we feel like there's a pathway for a company that, had some bump in the road, whether it was bad management, whether it's like you lost some major customer and time and there's a pathway for them to recover, we'll take an active role to make sure that we don't leave, money on the table for our debt investors, our equity investors. We want to be able to maximize recoveries. So, covenants to us, because we're actually able to see, we get, monthly financials from these underlying companies, so you tend to be able to see a problem even if probably before someone actually breaks a covenant. So you're having a conversation with the company, you're having a conversation with the financial sponsor who owns the company. So to us, that matters a lot because it gives you a fair bit of protection if, there is a problem. And candidly, you see problems coming probably sooner than someone actually broke a covenant.
We think, on a $15 million to $50 million loan, covenants matter. That's not where we lend. We're lending from a couple of thousand to, say, 10 or 15 million. And we trade off personal guarantees for every 20% equity owner or greater. And they're joint and several. So our borrowers are all in. It's not like an LBO sponsor or some financial player that's making a bet, and if the deal goes bad, they throw their keys at it. Our borrowers have their whole life on it. They've got personal assets pledged. Our loans are typically collateralized by hard assets like commercial real estate or residential real estate, about 60 to 65%. So we trade that off 60 days down, and that's why we don't burden these smaller middle market companies with covenants. 60 days down the road, if they haven't paid, we're basically telling them they've got to be current on so we have a monetary covenant. They've got to be current, otherwise we're taking all their assets. That's a hard explanation to go back to your spouse, other guarantors, whether silent or active in the business. So that's a trade-off that works for us. Now, you would say, why do businesses still take the money? Well, number one, they certainly believe in what they do, which makes us feel very good about it. Two, they want a 10 to 25-year AM, which lowers their payment, which makes it a much more affordable situation. They're in a single-digit interest rate, and they don't have to have the expense internally of dealing with leverage ratios, liquidity ratios, things of that nature, where they'll typically get tripped up. So it fits for our world, and it works, and we don't think by not having that. However, we do think when you're looking at the $15 to $50 million space, and it's very cash flow oriented, you want to have those early warning mechanisms.
And just, I think, so that people can understand, what kind of loss and defaults do you have? Because your model, well, I think we need to clarify, you're not a loan-to-own guy. You don't want these assets, right?
Well,
I mean, you don't want to look like you're a pawn shop.
No, that's very true, because I think you need a license for that. But, and although I am from Brooklyn, I've never experienced it working in a pawn shop. But, no, our rates are typically prime plus 2 3/4, or if they're fixed, they range from 7.5 to, say, 9.5. And, for the borrower, effectively, we will consider over-advancing on the primary collateral. Banks want 30% down. We might do 20% down. But that's just on the primary collateral. So we'll take secondary and tertiary collateral, which gets our total LTV down. But on a bank's book, an 80% LTV, that could be pushed into the classified bucket. So we figured out a marketplace that banks have no interest in, but borrowers who want a little bit of extra leverage, who want a long amortization schedule, who don't want covenants, they come to us. And importantly, they come to us without brokered intermediaries. that are showing the deal to us and 5 other people, and then you're in a jump ball. We're in a negotiated basis. Our referrals come from alliance partners. We looked at $18.8 billion of referrals last year. We fund about 2.5 to 3% of what comes in the door. This year, we looked at $5.4 billion in the first quarter, so that number is rising. Believe it or not, we looked at 64,000 borrowing opportunities last year. So we've got a whole process set up internally with about 180 people in the lender, looks at them, parses them, puts them in a file vault, puts a credit memo, goes to committee. We've sort of used technology to smooth out the lending process.
Gotcha. One last question, then we will, for you guys, and then we will go to some Q&A if that's okay. Pennant has actually had one of the few purchases of another BDC. So I think there are other ways to grow, and I'm going to let these guys both talk because they both use sort of different strategies. You with Tenenbaum, BlackRock, you with the acquisition of MCG's portfolio.
So I want to say we're going on, maybe that was like 4+ years ago, that there was another, I think you alluded to that there are some smaller BDCs out there that, have just decided it's a hard business, and if you're not growing and you're not doing well, people have from time to time put themselves up for sale. This was something that actually went to a wide group of people. We tend to look at almost every opportunity that presents itself, but I think MCG for us was a little bit of Goldilocks, so that was acquired by PFLT. Because here was a business that I think had about $175 million of assets, though $100 million of it was effectively cash. So the other 75 was what I would dub, there were 20 probably somewhat idiosyncratic loans that, didn't look the way PFLT's first lien loans typically look, but we're, with, 20 loans, it's a very easy thing for our team to be able to dig in and, dig in very granularly about, is this a loan that you feel is comfortable? And from the time we announced the deal to the time it closed, the 20 loans basically went down to 2 loans pretty much because they did pay off, and we concluded that the loans were fairly marked, and so we were, I think, a successful bidder, but we used this as a way to what we thought was just sort of thoughtfully grow the business, because at the time, PFLT, our first lien focused BDC, was small. I mean, and if you think about the sort of size of the market opportunity in, sort of financings, the typical capital stack is, 50 to 60%, equity by a financial sponsor. The top part is probably, say, 4 turns or, 40% first lien and then 10% second lien or mezzanine. So like the notion of how we've wanted to grow our business to be even more and more relevant to sponsors, if you have a seat at the table when you're able to offer people, we like the first lien of this loan probably more than we like the second lien or vice versa. It just became important for us to be able to be, I'd say, more and more relevant on the first lien side. And so that was a logical way for us to grow that business without, taking on any real risk. So we were very excited that, we were able to integrate that portfolio.
That's great.
We think acquisitions clearly are an interesting way to grow. We looked at one recently. We trade about 1.45 to 1.47 the NAV, and this was prospectively available at a discount. However, some of the hesitations were, if we did this, is my investor group going to go, why are you doing that? You're changing your mind. Now, the reality of it is, if the assets are inexpensive, we have to go through about 25 to 30 credits. It probably made sense. But frankly, the other bidders are probably better bidders for these types of assets because our return on equities historically have been very high. So ultimately, at a price, we were interested in it, but given how high our return on equity has been to shareholders, it's hard for us to compete in the space. But it clearly makes sense to try to acquire a block of assets that's accretive to the dividend and accretive to NAV, we'll look at them. I just don't think we could be competitive given what our other businesses are doing, and we're probably better off sticking to our knitting rather than looking at this other opportunity. It was only 25 to 30 credits to analyze, but we still took a look at it, but we weren't competitive.
But to be fair, you've sort of looked at it a different way, maybe just a minute on your JV with TPC BlackRock.
Yeah, so we just announced a joint venture with BlackRock TCP, gotta make it TCP, right, I always invert those. And they're gonna put up $100 million, we're gonna put up $100 million over time. We have a leverage facility from Deutsche Bank to launch what we view as non-conforming C&I loans. I use the term non-conforming. It means it doesn't conform to a government program that we've excelled in over 16 years. However, the credit box is the same. So it's the same credit box, it's the same credit thesis. Generally speaking, the loans are just larger. So it's our loan assemblers, it's our underwriters, it's our $18.8 billion of referrals from last year on a run rate for $20 billion this year, because plenty of our referrals would be eligible for this. So we're launching this program, we're really excited about it. This joint venture doesn't consolidate because it's even Steven, they have an equal say in what gets invested in, we have an equal say, but we are using and leveraging our infrastructure. So this is a way that we're actually utilizing operating leverage as an internally managed BDC to take advantage of this particular market opportunity.
Thank you. We just have a few seconds here. Are there any questions in the room? Oh, hello, Nicholas.
Thank you very much for a great panel. My question is there a sweet spot in terms of the average loan size? I mean, you described how labor-intensive is the whole process, so...
Well, I mean, I think we do very different things, right? So your sweet spot's going to be different from ours. So when we think about, a middle market loan and, we're able to, look, we like the sort of sweet spot in size in terms of whether it's a company of, say, 15 to 35 million of EBITDA. And then if you're thinking about that with a sort of a first lien where maybe that has, pick the easiest amount, so it's $20 million, that may have 4 turns of leverage. So that loan may be $80 million. And for us today, and where we can allocate based on exemptive relief across our varying funds, because we also have some private funds based on available capital, so no fund is disadvantaged, we would probably max out at like 40, because like if you look at our portfolio, we don't want to we're highly diversified in terms of concentration in our 2 publicly traded BDCs. So you don't want, more than 3% positions in any given name. I think the PNNT has something like 66 portfolio companies. PFLT probably has about 82 different portfolio companies. So that might be something where we could speak on the high end to say 40 million of that, and then it would get allocated probably across a variety of funds that we manage, but still keeping a lot of diversity. And that's part of why we've been, growing the senior side of our business. So you like to be able to be relevant. We'd probably club with another BDC or some other private fund lender to solve that solution, if that makes sense.
With respect to sweet spot, we look at it more from a credit standpoint. Been in business 2 to 3 years. Average FICO score of the guarantor 700 or greater. We like to have 65 to 75% of a collateral be hard collateral, commercial or residential real estate. And on that basis, we don't mind whether the loan is 100,000 or if it's 10 or 15 million. We want to make that loan, and that's our business model. Have all the opportunities come in, shape them for program 1, 2, 3, or 4. But in that credit position, we know what we're going to have between 4 and 6% charge-offs that are going to occur over the course of 12 years. That works well versus the coupon on the gain on sale income, and we get high rate returns on equity.
I think if you look at it universally very quickly, the very big BDCs don't have the time to do the smaller stuff, the 40 or 10s. They're really, the big guys are really out there buying syndicated LBO loans. where they're writing couple $100 million checks across their platform. So that is a much different sort of business than we have here. These are two pretty unique and we think very good BDCs in their own right, and that's why we had them up here today. So I want to thank you guys.
Thanks,
Nicholas, I
Thank
know
you
I'm out
for
of time.
having us.
Thank you, everybody.
Well, I would like to thank the panelists. If you allow me, a very special thank you to Rich. He is hosting this panel every year with great success. And BDCs are, as I learned from Rich, financing America's growth. So it's a key panel to have, and thank you, Rich, for doing it every year so successfully. And of course, thank you for having you on the panel as well. Thank you.
Thank you for having us.
Congratulations to your daughter.
If anybody wants to research, I got cards out there.
Oh, by the way, as Rich mentions, we have research on BDCs out there, so out in the hall. So please, if you would like to pick it up.
Take my card, email me, and we'll send it to you.
Yeah, and let us know, and we'll put you in touch with Rich, and you can have it. As Rich pointed out, the availability of research is one of the key differentiating factors for
Absolutely.
BDC. So, and Stifel is producing a lot of it.
Thank you so much.
Thank you,
Thank
Rich.
you again.
Thank you.
Thank you so much, appreciate it.
Thank you for having us.